All right, let's get started with your Chapter 12 homework. We're going to be looking at adjusting entries. Again, there's going to be a lot of similar transactions in Chapter 12 that you had from Chapter 5, except there's also going to be some new types of adjustments. So there is some review concepts. All right, so let's get started. All right, on the first one, we're going to have what they call a bad debt adjustment. So we have some credit sales. So as you all know, that's going to be accounts receivable. And it says that in this problem, 1.5% of those are going to be uncollectible. So sometimes you do have credit customers who do not pay. So what you have to do then is you have to estimate, this is the matching principle, estimate how much of those credit sales you can't collect. So the method they're using here in the book is they call it the income statement method because we estimate it based on the sales on the income statement. So what you do is you take that 2,020,000, I'm going to write this one out, and you simply multiply that by 0.015. Because they say that 1.5% is going to go back. So down below, you can see, I'll just kind of show you this. This is your entry. You'll debit your uncollectible accounts expense for $30,300, and then this account, which is your allowance account, allowance for doubtful accounts, that is a contra asset. Just like you have contra revenue accounts, this one's a contra asset, very similar, kind of like accumulated depreciation. It will reduce your accounts receivable on your balance sheet. Right, so this one right here is $30,300. This one is a brand new entry. We did not do this one in Chapter 5. All right, so that's the first one. All right, second one you have done, this is going to be depreciation. So they give us the cost of the equipment, 8-year life, salvage value $3,500. Remember, we're doing the straight line method, and they want the adjustment in this case for the whole year. So again, I'll write the calculation out to remind you what you do is you take that cost, which again is $42,500, subtract out, in this case, their salvage value of $3,500, divided by 8. And the reason I'm dividing by 8 years is because in this particular question, they wanted for the year. That's their time period. If they wanted a month, then I would divide it by the month. But in this case, it's divided by 8 years. And that's going to give you, in this one, looks like it's $4,875. Notice, again, you did this one in Chapter 5. Debit depreciation expense and credit accumulated depreciation. All right. Now, the next one, let me clear this, is simply a payroll accrual. And it just says in this one that you owe wages of $12,200. They're paid weekly. All you do is you debit your expense account and you credit a payable for the $12,200. They call this an accrual payroll. Notice you have an expense, but you haven't paid it yet. But because you've incurred it, and that's the key word, you've incurred it, you have to go ahead and record it. All right. The last two is very similar to that, except you just have to do taxes. On the first one, it's going to be Social Security tax and Medicare, and you just have to apply these rates to what you accrued for payroll. So for individually, for each of these, what you would do is for Social Security, it's 6.2. So you take the 12,200 and multiply that by 0.062. And then for the Medicare, it's again 12,200 multiplied by the 0.0145. And you can see right down here, here's going to be your accrual entry. They just debit a payroll tax expense. And then for the Social Security part, it's just put some sort of payable and then Medicare tax payable. And then here's the amounts that you should come up with. All right, and then again, you have to do the same thing on the last one. On that one's going to be unemployment. And as you can see, unemployment, it's 0.6% for federal and 5.4% for state. And again, you just take these individual rates, multiply them by the 12,200, and notice you'll have a payable, federal payable, and a state payable, and then you just debit the payroll tax expense. All right. All right, that is problem 1. Let's take a look at problem 2. Now, in this one, we're going to get into some review, and then one of them, the new one's going to be on the interest. And what I often tell my FACE students is, remember with interest, is the concept is principal times rate times time. So on letter A, it says we have a note payable of $18,000. So $18,000 would represent the principal. We're going to multiply that by an interest rate, which in this case is 8.5. So I'll write 0.085. And what I do is I always divide that by 12 to convert that to a per month interest rate, because the interest rates they always give you are an annual interest rate. So that's our rate. So basically that's going to be a monthly interest rate. And then our time period here is going to start on November 1st. So November 1st through December 31st, of course, is 2 months. So then I multiply this by 2, and then that's going to give you this amount, which should be $255, which is going to be your interest expense. So notice your accrual here, because you haven't paid it yet, is you debit an expense and you credit an interest payable. So this is a new one in this chapter. It's called interest accrual. All right, so that is part A. Let's check out part B. This one should be reviewed. This is just supplies. So we got 6,230. It says 1620 is left. And the difference between 6,230 and 1620 would give you 4610. That's going to be your supplies adjustment. On the third one, you got some prepaid. The premium was 14,640. It's a 1-year policy. It was purchased on October 1st. So always remember to watch your dates. So remember October 1st through December 31st is going to be 3 months. And so what we'll do on this one is we'll take that 14,640, divide by 12, because it's a year, so 12 months, and then multiply by 3, because that's the time period we want is 3 months, and that's going to give you your 3660. Last one on the prepaid advertising. And again, this is for a 1-year advertising. Notice the date, it's June 1st. So the balance was 13,200. So again, you take that 13,200, divide by 12, and then it looks like since it's June 1st, you're going to multiply by 7, because remember June 1st through December 31st, that time period is of course 7 months, and that should give you the 7,700. All right, and that would take care of that one. And then down, and then I think that's it they give us on that one. All right, good. Number 3, let's check out number 3. On this one, they give you the amounts, but I'm going to show you how they came up with it. So they borrowed $50,000 from the bank, and the bank is going to go ahead and take out the interest in advance. So the way they're going to calculate that interest, it's the principal times the interest rate. And it looks like the interest rate is 9%, so I take that 0.09, divide that by 12, and it's going to be a 4-month loan, and then multiply that by 4. That's how they got the prepaid or the interest of $1,500. So we get $48,500. We prepaid it, so that's going to be called prepaid interest. And then notice the balance. We still got to pay off the principal. That balance still goes to notes payable of $50,000. So then 1 month, at the end of the month, we then take that $1,500, all right, and simply divide by 4 because it's over 4 months, and that's where they're going to come up with that $375. So that would be your interest expense, debit for $375, then credit your prepaid interest for $375. That's how that one works. All right, that's number 3. Let's check out number 4. Again, more notes payable. So again, I like to write these out. So notes payable has a balance of, it looks like it is 72,000. So there's our principal. Interest rate is 6%, 0.06. I divide by 12 to get a monthly. And I look at my time period. This was on December 1st. So then just multiply that by 1 month. And that'll give you 360. That'll be your interest adjustment. Debit interest expense, credit interest payable. All right, let's check out number 5. And again, now we've got notes receivable. Notice anytime you see notes payable or notes receivable, typically there's going to be interest. And the way you calculate interest is essentially the same. You're just going to change the amount or the accounts. So on the first one, it looks like the balance is 25,000. So that's our principal. And it's 6 months, it's 6%. So interest rate's 0.06 over 12. And then this happened on September 1st, notice. So September, October, November, December is 4 months. So multiply that by 4, and that will give you $500. That's going to be the interest. Now, in this case, it's interest earned. It's not interest owed. So look at the different account names. It's going to be interest receivable, and of course, interest income or interest revenue, whatever, debit, credit. All right, that's letter A. Let's check out letter B. And on B, it looks like this is going to be unearned revenue. Remember, unearned revenue is essentially where we received all the cash up front. We just haven't earned it yet. So this is actually a liability account. So we want to figure out how much we've earned. And in this problem, it looks like it says 60% was earned. So all they do is they're going to take, what's the amount? It is, I lost it. Oh, no, I'm sorry, it's 90,000. So if you just take the 90,000 and multiply that by 0.60, there's your interest earned. Notice the journal entry. You're debiting your liability. I'm just going to make a note to remind you that is a liability account. And then you credit your subscription revenue for what you've earned. That would take care of letter B. All right. Letter C, this is going to be unearned rent revenue where we've been paid the rent. We just haven't earned it yet. So we've got 37.2. It covers 6 months. And this happened on November 1st. So essentially what you could do on this one is simply take the 37.2, divide that by 6, and November is the date. November and December is the 2 months, so multiply that by 2. So we've actually earned, looks like $12,400. That's how you calculate that. All right, last one, same thing. This one looks like we got revenue for tickets, 60 home games. We need that number. We got $9.2 million. And it says we had played 6 home games. So essentially what you got to do is you got to take that 9,200,000. We'll divide that by 60 and multiply that by 6 because that's how many games we've earned. Comes out to 920. Notice you debit your unearned account. There's your liability, and then credit your revenue account. All righty, that takes care of number 5. Let's check out number 6. Now on this one, I had to I'm going to give you this one because the way they adjust inventory, I will not test you on this one, so I'm just going to give you this. So for letter A and B, if you get stuck with it and you email me, I'll let you know, but essentially they're using income summary to make an adjustment to inventory, and I'll just kind of give you a heads up, that typically is never done because most systems these days are all perpetual. But all they're saying is that, for example, I'll just read the first one. Inventory has a balance of 7,800. Newly accounted balance is 8,300. And they want you to come up with some sort of adjustment. And if you look at what they do, is they use an income summary to make this adjustment. It really is kind of weird, confusing. So what I'll just kind of tell you right now, whenever we get to this part, is if you get stuck on these two, you can pretty much ignore parts A and B. It's totally bizarre on how they do it, but essentially they're using an income summary account to adjust the inventory. But in case you just want to plug in and get the right answer, you can just literally copy these two. I never do it this way in class in terms of I never teach inventory adjustments this way. There's actually a better way to do it, but because of the scope of this class, we don't spend a lot of time on this. You'd get more in financial accounting. You can just copy these when you get there. So I'm more concerned with the rest of these. And so the rest of these in this problem is starting with letter C through K. And you'll note that essentially these are very similar to what I've just showed you in the previous problems. In the first one, you have unearned revenue, unearned seminar fees. And notice it says it's for 5 seminars, June, July, and August. 2 have been conducted. And so you've earned 2. So essentially, it's just you have to do an allocation, all right? So what you do essentially, let me get that out, is you take that 6,300 and divide by what, 5, and multiply that by 2. That essentially is how much you earn. And so as I page down, that's where they're going to come up with this amount right here, 2520. Notice you debit your unearned account and credit your fees income account. All right. Letter D, I think you should be okay with. That's just a prepaid. You've done those before. The same thing on letter E, that's going to be depreciation. And you have a couple accruals here on some payroll. Letter H is your bad debts expense. And again, I'll remind you, again, on that one, I'll write that one out. Remember on your uncollectibles, again, referring to this one right here, you just multiply 2.3 million times 0.01. That'll be your adjustment. And then I think the last one, I'm just going to write this out, and then I'll show you the entries on the last one where they borrowed the money. So just remember on this is letter K. So 4,800 is the principal. Interest rates 9% over 12. And they borrowed this on June, so they want end of June adjustments right here. So then just multiply that by 1, and that'll give you your interest. So let me just kind of page down and show you some of these as you practice. These are what all the entries should look like. We've essentially done them all at this point. If you get stuck or have questions on any of these, again, you can email me. But remember, you have unlimited attempts on your homework, so just keep submitting these, and they should give you some hints as you go. The analysis is just telling you how much. It says after all adjusting issues have been realized, what's the balance of prepaid. So you just have to do an update to your ledger account. All right, that's number 6. Number 7 is more. Now in 7, they have you do all the initial entries, and then they want you to do the adjustments. So all of the initial entries are, notice it's all at the beginning of the month. So you signed a lease, so you have prepaid rent. On the first one, another one on July 1st, you borrowed money, so you'd be debiting cash, and the difference there would be the prepaid interest that the bank took out. And then you have another agreement where you have some unearned revenue. You bought some equipment. That's going to be a depreciation adjustment. Here's some insurance, prepaid insurance. You bought some more furniture. That's going to be some depreciation adjustments. And then some office supplies. So let me have you look at these are all these initial entries. And note also, so you got, here's your prepaid rent, and then there's that prepaid interest that the bank took out. There's your unearned revenue. Here's where you bought some equipment. Notice notes payable. On this one, you could have some interest adjustments. On this one, you'll have an interest adjustment and a depreciation adjustment. Again, I'll show you that in the second part. Here's your prepaid insurance. There's your office furniture. Notice this one's accounts payable and not notes payable, so there's no interest on this one. You typically only have interest on the note. And then, of course, the last one is supplies. So let's check out. Here's going to be your adjustments. And you'll note, again, here is your rent expense. There's your interest expense, unearned revenue adjustment. Again, notice I said on this one you have 2 of them. So you're going to have an interest expense adjustment, and then there's your depreciation. Again, you have another insurance adjustment, another depreciation, and of course your supplies. Now in this one, I didn't walk you through all the individual calculations individually, but I think if you kind of go back and review the other exercises and kind of, you can kind of compare your results to the actual correct answers. Again, if you cannot get them, again, let me know. I'll be glad to give you a hand. All right. The last part just has you do an analysis question on your unearned revenue. All right. So this is a long one, but it's a really good practice one. I think you'll get really good at this stuff once you get to this problem. All right. Number 8 is the last one. And notice you already have these accounts and their balances set up. And then again, I'll tell you with this inventory, I'll get to this in a minute. The first one is an inventory adjustment, but the rest of these, you've done these. You've got rent, insurance, advertising, prepaid, office furniture. So those are going to be some depreciation adjustments. Here's going to be an interest adjustment. Notice the date, July 1st, 6%, 17.7. And then that's going to be an unearned revenue adjustment. And then you'll note that on this one, you can see the amounts. They copy these amounts down into this trial balance for this partial worksheet. And then you can kind of see how they're doing all their adjustments. These are all the different accounts. All the adjusting entries are simply listed in these columns here. And hopefully you can kind of, as you're comparing your answers, you can kind of go through these. You can kind of go through these and make sure you can come up with these right adjustments. And then, of course, they want you to come up with an adjusted trial balance. All righty. And then the last part is just to do an analysis, and then you can compare your answers in terms of the expense accounts. All righty. And that should take care of your Chapter 12 homework.